Three big things need to be talked about right now. The first is the inflation numbers. Of course, we now know that the markets have shown us that probably inflation is no longer the biggest sticking point. The initial reaction was bullish, then it took stop losses, and as we expected, that was the false reaction. Markets then sold off straight after it, and it could be setting up for further pressures moving forward. We also saw the FOMC meeting minutes from March. Guess what? Now we have central bankers around the world claiming a mild recession is coming for the US. Is this foreshadowing something much scarier in the back end? And on top of all of this, one of the biggest hedges in the world, gold, is still incredibly bullish. We've gone back over 40 plus years to have a look at whether this is sustainable for the metal. And again, whether everybody's getting a little too excited. We've got all the big information. Let's get into it right now. Well, welcome back everyone to the Daily Show where we talk about markets around the world, including stocks, commodities, and cryptos. We've got all the hottest charts coming up, but we'll start off here with the news and macro. If it's your first time here as well, consider subscribing and of course, smash that like button if you find value in today's video. So let's get into inflation. So the data was obviously coming out a little bit more positive than some people thought, but markets didn't react the way that some people would have expected. I think most importantly, we're starting to see the lessening of impact for CPI data. In 2022, this was the hottest news. It was moving markets upwards of 5% in one session. Now we're back to kind of like a 1 to 2% tolerance. I believe earnings, as I've said since the start of 2023, will be the most important factor for the rest of this year. Do we see earnings compression? But let's talk about the CPI number. So it was pretty good. It increased by 0.4%. Overall, some of the biggest contributors were still shelter, and we saw shelter rising by a significant margin. Food was down, which is a positive sign. Energy was down heavily. However, I do expect that to probably spike back up due to what we know is going on in the markets right now. And I don't really think there was too much enlightenment off that inflation number. More importantly, I think that we're now moving past that to really discussing what the Fed is going to do and how long are they going to hold rates to stop the kind of issues that have happened back in the past during, of course, the 1970s and the inflation now. So the FOMC meeting minutes showed us that literally some staff are predicting a recession now. So it says here, the staff's projection at the time of the March meeting included a mild recession starting off later this year with a recovery over the subsequent 2 years. Can you believe a central bank is literally cushioning us now to expect a recession due to what they've done? It's almost unbelievable they would say such a thing. And does that probably mark something worse behind closed doors? What do you think in the comments down below? Is this more of a smoke and mirrors kind of thing to try to create more demand destruction? Or is it something more sinister going on that it's way worse than we even expect and things are going to get bad? Let us know. We'll read out some of the comments, which is something I want to do on this show to get the community more involved. And yes, I'm not going to read out those spam comments that we get all the time on the channel. YouTube, if you can, fixed it up. Come on. I've thousands and thousands deleted those. I know they're annoying. I see your comments all the time about it. So let's talk about target rate probabilities. This is significantly basically sitting around 70%. It's been consistent here. So this is in May. The expectation is basically for a rate hike of 25 basis points to continue to combat inflation, to get, I guess, the federal funds rate above inflation, which we'll talk about when we look at one of our tweets a little bit later on. And then in July, we're starting to get like this idea that maybe a cut or definitely a pivot pause should be present. So that's kind of the new stats that are coming out. Not much change after the CPI number. We also know that US stocks are not cheap right now. They're not super expensive. I think this is a good one, pretty expensive. And that's how I'd look at them. They're trading at about 18.6 forward PE. And this is on fairly optimistic numbers as well. So generally speaking, if I'm an investor, I really like to get underneath 16 PE forward, maybe 15, 14. They're great times to be looking at these markets. Let's talk about inflows recently. We use this chart quite a lot, which is smart money versus dumb money inflow. It is not a timing tool, but what it does show us is when we have to be cautious. We saw the markets come back up to a supply or a resistance area over here. And they've reacted in a way of probably starting to show us, and especially if we get a few more points down, a very significant turnaround event. Now, if that has happened, look at what smart money's been doing and look at what dumb money's been doing. They've crossed each other. We're expecting dumb money to continue purchasing here, and we'd like to see smart money drop off. That usually shows that they're selling into us, and that's usually the way that it kind of plays around. Now, over on Twitter, if you haven't followed, links in the description down below, I posted a really important CPI chart here. And I'm going to quote a bit of Druckenmiller. Stanley Druckenmiller is a great, amazing investor, probably the best, in my opinion, ever in the US. And yes, I know most people know Buffett, but Druckenmiller, look him up. He's a boss. Now, he said a long time ago in an interview in 2021 that the Federal Reserve has never been able to combat inflation without getting the CPI number underneath the federal funds rate. Now, we are there. We actually just are crossing at this stage. So let's say we get one more Fed hike. We should be above it. The thing is, though, you have to hold it there. So as I've said here, you must hold the rate above the CPI number for some time to stop the inflation. And this is a very important factor. Usually will cause a recession. But see, what happened last time was they instantly cut. And then what occurred was we ended up seeing inflation continuing to be a problem. So it's all about making sure that when you instantly cut, you don't cut too fast. You have to keep these rates higher for longer and generally pause. And the market does not expect this at this stage. It still is not pricing in a pause. It's pricing in cuts. And I think that's one of the things that we talk about here on the channel that's a little bit different from other people's expectations. Let's now move over to gold before we get into the rest of the charts and the information. We've got a lot to cover here. So the first thing is gold has been an amazing rally. I've been incredibly bullish on gold realistically since last year in December. I got bullish again on it recently, and it's a great pair. And I still think gold will go to $3,000 an ounce over the next coming years. However, it's all about timing with gold. So if we have a look here, we've got some great, what looks like gold stock rising 200-day movements. Everything looks like it's going well. It's going from the kind of negative side all the way to the positive side and doing it fairly quickly. It's the speed at which it's doing it, though, that's kind of important. So you can see it only happens 18% of the time that we see markets kind of do these switches from the GDX rising 200-day and going from that 10 all the way up to the 80. But when we've had reads like this, it gets very shaky. In fact, have a look at this one. This is the Gold Bugs members with rising 200-day average cycles from the under 10 to over 80. When we see this, we tend to go into chop or decline. Now, these are some notable chop periods. There's notable chop. There's some notable chop. Again, notable chop. And it just seems to be quite consistent when you think about it that we go into these kind of sideways style markets. So I'm not necessarily convinced that gold's going to have incredible rallies. If we get through 2100 and get a nice weekly closure, that might change things. And of course, if yields just drive down off a cliff, then that's going to be positive. I've talked about the correlation with yields going down and gold going up for quite some time. Stagflation is also a problem. And of course, if you believe we're in stagflation, gold should do better. Now, this is the chart I'll update you all on. This is basically flow into gold. You can see pretty much from the back end of last year, gold has been historically quite well bought by big players, and that's a very positive sign. If this switches to the downside, I'll be the first to update you, so make sure you subscribe here on the channel. It's a pretty unique chart, and what this will show us is that the big players have actually dumped in. Now, you'll already see the dump in the stock, and you'll see the dump in gold price itself, but we're looking for those rallies to be probably faded at that point. Again, the stats are just not looking super positive for gold. In the previous video, we talked about equity risk premium. I just wanted to bring it up again. This is something that bigger players do think about, and that is how much risk do they need to take for the reward? I've been discussing with bonds traders recently, big ones, 10 billion plus kind of holders, that they need to realistically be making 9% to really consider the asset class. So because the risk-free rate, which is effectively treasuries or really quality government bonds or quality business bonds, are paying so much that we're actually moving down to these numbers. Now, when you see spreads like this, what a time to buy stocks. When you see spreads like this, it's a time to be cautious. And that's an investor principle, not necessarily a trade principle. So they're different, and I want to state that. You can see here equity risk premium, which tends to rise quite a lot during, of course, a recessionary period, which it looks like we're probably going to one. I mean, the Fed's literally told us that. So we're going negative 0.9 to 1.7. That's where we're just crossing into. And what we tend to see is annualized returns of very low numbers on the S&P. So although they're still positive, they're lower. And what that's telling us is that you don't really need to feel too much FOMO right now at this current time in markets, at least based on the stats. Here's Mike Wilson's work from Morgan Stanley. He talks about when you get a recession, usually you get these huge spikes in ERP. We'll be looking for those. That should mean that the stock market is relatively lower compared to bonds. And then you can probably look to maybe consider that as one of your triggers when it comes to markets. Let's move over to yield curve inversion. It's another little bit of thought process here. I wanted to bring it in. The longer we remain inverted, the longer the recession lasts for. And that's been something that has gone through the last 20 to 30 years. So if we look here at yield curve inversion, we're on month 13. So we're starting to really get in there now in terms of how long we're having to expect the length of a recession. So remember back in 2005, 2007, we had, what was that, about 18 months of inversion. We could approach that sometime later on this year. We do not see a recession until it crosses the other way. I'll explain that when we look at it on charts. This chart here, I'm super interested to see the sentiment this week over the next 6 months. If this has turned to like 40% bullish, watch out, bulls, because that will certainly not be good. We will update you here when that occurs. We also know that we're basically at this point, at this stage in the economy, this is usually what happens. We get a curve steepening. We've seen that. That's the yield inversion. We get credit tightening. That's Credit Suisse, Silicon Valley Bank, and all those other things. We go sideways for a couple of months with maybe another hike or something, and then we kind of go sideways. And then all of a sudden, the Fed will cut, not out of the goodness of their heart, but because they broke something, which is going to happen. And then generally you see these kind of drop-offs. Let's just quickly scroll through some charts. I've said before, there are lagging impacts due to the Fed hike and what they've done. That's probably been brought forward. So we should start to see it over the next 3 months, the next quarter, in terms of the tighter credit conditions really hurting a couple of zombie businesses that don't make money, that just won't be able to get financing. The majority of these declines obviously happen after the Fed's pivot. We know that's generally the way it is. Of course, in the past, that's how it's been. And you can see we usually get that sugar rush coming into it. So it doesn't discount that markets could go up even a little bit more, but this is usually the way you're looking at it. Fed is tightening. We also know credit is tightening now. Usually that means a recession's coming. I think it's pretty clear on this chart here that a recession's coming. This chart shows us a recession's coming. This chart here shows us a recession's coming. You know, it pretty much gets fairly significant. Now, could this time be different? Everything could be different, but at least all the stats are stacked there. The word recession is overrated. Really what we're looking for is a compression in the stock market, especially in terms of forward PEs, to allow us as investors and traders and everybody else to get a better price. You know, we don't really want to see this kind of federal-induced 20 forward PE to 24 forward PE average S&P. It's not really a good value market that's going to give you long-term quality returns. It's going to give you substandard returns, 5.5%. That's not really what you're looking for, I'm sure. So let's talk about the no recession path. This is where we are right now. If we end up going to a recession path, history would tell us that we should technically make a new low. We'll have to find out about that, but I'd like to see some compression in the forward PE. Here's where we are. You can see it's not cheap, nor is it super expensive. It's kind of okay. I'm going to say that's okay. So if you're a long-term investor, I couldn't hate this price, but you know, I'd like to see a little bit better. VIX versus the bonds market, we obviously see a huge detachment here. The VIX is super volatile. The bonds, not volatile at all. The move or the bonds market is super volatile. When we've seen this in the past, it's led to kangaroo or sideways style markets. You can see all the reads here and all the data. I've brought this up many times, but I think all this data is really, really important. EPS growth turned negative a little while ago. We're coming into earnings. Remember, this Friday, we have the big banks, and these are the implied vols. I love this because it has the implied movements based on the options prices. Look at Wells Fargo, almost an 8% implied vol move. That's actually well above where it used to be. For something like JP Morgan, we've got almost a 5% implied move to 6%. So there's some pretty large moves coming into this Friday's announcement. Let's have a look at rotation before we get into the charts. Rotation in the last session was more of the same, technology kind of bearing the brunt of the markets. We saw consumer discretionary ahead of retail sales as well, going down 1.55%, which is quite interesting. So if that continues, could be a turnaround here in markets. We've still got utilities and healthcare, two incredible defensives out in front over the last 5 days. I've been talking a lot about utilities over the recent months. So it just shows you how it's important to look outside the box. No one thinks utilities are sexy, but it's where if you can make money in a pair that's maybe a little bit more safe and a little bit less talked about, then why wouldn't you consider doing it? Let's move over here to US 10-year versus US 2-year. Remember, a recession will never happen until you actually usually go above the 1% here. So basically cross away from inversion. It's when the inversion goes away that you actually need to be scared about the markets going poorly. That hasn't happened yet, so it's unlikely to happen anytime soon. Let's have a look at high yield bonds. Did they drop with the market? The answer is yes. They came out fairly strong and then all of a sudden they turned back around. So that's a positive sign for the bears, obviously seeing the markets like that. Let's have a look at TLT. Treasuries held up okay. Basically, rates remained almost the same. They just flatlined. So again, another interesting day here for treasuries, but nothing too spectacular. Let's move over to copper. So copper was able to actually go up and it came back to this trend line we've had for a while. So kind of now needs to turn to the downside. Maybe the next 24 hours for copper will be interesting. We're only watching this for the reason of seeing whether the metals market is agreeing that there's a sickness in these economies and therefore a recession and other problems. Let's move over now to the dollar index. Now, this got absolutely smashed straight back down. Not a good daily close for this. Again, rallies should be met by sell demand. I think at this stage, it's a super crowded trade to go dollar bull. 90% of retail trading action is actually going dollar bulling right now. I know you might find that hard to believe, but it's like some obscene amount, 85 to 90% on most of the flows that we're seeing in FX. And that's not really a great predictor. Now, when it goes over that 90%, which it kind of is at the moment, generally there's a bit of relief. We saw that here, then we smash back down into it. But let's take a look at the weekly. I think the weekly will be the teller. If we get underneath this line here, which is the yellow one, I just believe, again, it's just unfortunately some more demise of the US dollar for now. And that really has to do with forward pricing the idea that there's rate cuts coming. There will be jumps, there will be drops, but at this stage, it's a multiple attack kind of on I guess, the US dollar. And if we keep falling through the next level, I expect it to get to somewhere around 98.60 to 99. And that's where I expect buyers to recommence. Let's move over to gold here for a second. So if the dollar does fail, could gold go up? Absolutely, it could. But again, I'm looking at things like the weekly here, and I'm really interested to see a really nice close above that kind of 20-30 zone. If this occurs, then maybe gold's got a little bit more legs in it for now. But the stats are starting to say that gold should either consolidate, or if it does have one last rally, it's more likely than not to go to like a 3,000 or a really high number. If you see a lot of people talking about gold 5,000, gold 10,000, that usually means you're kind of at the end of that nice run. And we've been following it for quite some time. So obviously, I expect gold still to do well over the next coming years, but just be cautious here. We'll keep seeing the price action. In fact, I'll just have a look here at the 2 hour for you guys. I don't think I see too much action here. We initially got that reaction thanks to yields going lower. That was good. If yields do drop through, especially the US 10Y through 3.32, I think it is, then once a closure happens underneath there, gold could have a nice rally spike in it. But you can see where it's at. Previous supply, it's kind of testing around there. I don't really like this for either action at this point. I think it's at kind of a fair level. Let's move over to natural gas. Nice pullback on this. I'm still relatively bullish on gas. I think gas has taken these lows correctly, which is interesting and nice. We're seeing that kind of rotation. Ideally, you find buyers right here. There are some ways to be saying that when it rallies, there could be shorting now at around 2.27 for natural gas. However, if it breaches through and we get a new high, I think gas could have a nice run back up to 2.5-ish on the gas run. It's a dangerous pair, as you know. 30% plus per day is very possible. So is this a flag on oil? A lot of people sending me this and saying, look at the flag. Well, I was cautious to claim that it was going to short here initially. And the reason was because it was too obvious. Everybody could see that one and everyone was thinking it was short. We ended up getting a breach out, which is fine. That is usually a strong sign. So now if you're a oil bull, let's say you are an oil bull, you're probably looking for the market to come back into somewhere in this structure, probably somewhere in the middling zone. Probably draw a fib between this and this, so we can do that now together. And the way you'd be looking at it is basically to kind of use the principles of resistance becoming support, to also pull and take the stop losses here, which would be pretty interesting, and then also to come into a fairly heavily traded zone. So yeah, I mean, you'd have to remain bullish here. I'm going to look for the weekly close. I don't really have any skin in the game here on oil anymore. So the way I think about it is I don't like demand destruction. And all of this yield going down, if we get underneath 3.32 again for yield, I don't think that's positive for oil. So overall, I'm actually quite negative in terms of the way I'm looking at it. But I'm more than happy to be patient. Remember, the last 24 hours should have proved that patience and reacting to the market news was the perfect action. I'll show you that when we look at the S&P 500 in just a few moments. So for oil, yes, it broke through. I expect kind of a drop to be met by buy demand somewhere around that level. However, after that, if it rallies, then falls again, it could be actually setting up for a really nice short, but you have to see more. We don't know that information yet. Tesla moved straight back down. It was a pretty wild day. Opened a gap up thanks to the CPI and then just sold. Tesla's reducing its car costs all the time, and that's probably demand destruction in place and also competition coming through. We're back at an interesting level, but you look at the weekly, you can't like how it looks at the weekly at the moment. And, I'm going to remain kind of on my point here of, I still think 145 is pretty real. There's a massive gap down here. And if the markets do fall off, I don't see Tesla being a huge benefactor of falling off. I think it's going to be sold a little bit more heavily than some of the other stocks actually out there. Let's refresh the options market just to see what's going on the 14th. So you can see here a lot of 200 calls, 190 calls. Well, we were never bullish past those points, so that's definitely not good for them. Max Pain is a little bit higher than where it is right now, but overall not a huge amount of puts. So mostly it was a call fest. And unfortunately, those people are they're probably going to lose their money. Let's have a look at Microsoft, still sitting with a potential island reversal. If markets did dump off here, then we could get a pretty decent sell-off. It's not as clean as this one over here, which was a fantastic sell, but certainly if it does gap down, that would be interesting. Nvidia, Apple, so many others, they're showing signs of being close to the top. I still wanted Nvidia to take 289, so I'm not going to say it's over yet. However, it's at these highs. Some people probably on the smaller timeframes think it's a head and shoulders and all sorts of things. I'm not willing to say that yet. If you look at Apple, interesting thing here about Apple was that it hit. Ignore these expected highs, by the way. They're not right, so I'll get rid of those. So if you have a look here at the downward trend line that we've got in Apple, it actually tapped something it's done all of these rallies. Apple's always found lots of buyers and then just suddenly switched here. So another critical level that was reached in the previous session. We're probably coming back down into a little bit of a maybe temporary relief area for Apple, which should sit around 158. I'm not positive on this stock, though, at these prices. I just think that it's a little bit too expensive. Same thing on stocks or semiconductors. You're starting to see them hitting these critical levels and kind of showing the signs of rollover. Is this a BC? Is this a UT? Question mark. We're going to find more information out. Volume's obviously fairly consistent. So I do think that there's a lot of risk on the bull side here. And the bull side really just points towards like a 4,300, 4,350 being the best. And we need to break some key levels here on the market we'll look at soon. Utilities still holding up nicely in that resistance. RSP, so this is the equal weighted S&P. You can see it's still held that zone. Opened up, probably took a few people's stop losses here if they were trading RSP, and then sold straight back off. So it's showing that the overall weight of the market is going down. The DAX, another break, then breach, back down. For the DAX traders, if you want to see shorting, you need it underneath 15,482. If that occurs, then we've broken the demand here, and we're most likely then moving towards short. So we'll watch the DAX, we'll watch the overseas markets. We've got the Australian market here taking that high, selling off a little bit. I still think it's at a critical resistance. So, if I was to pick a direction, even though the trend's up, this is where the bears should sit. If we move over to the US 2000, the small caps, interesting, straight into that 1800 level, sell straight off. Look at that shooting star. That's a shooting star and engulfs the previous candle. Again, it's proving, and look, it closes on the low. So it says that kind of rallies should be met by sell demand. And when we look at all these US markets, let's look at them together here. Look at this, closes near its low. Take a look at what the Qs did. They actually made a new lower low here. Just did it. The NASDAQ futures, if we have a look, they actually did make a lower low. So a fairly significant closure here on markets. We're going to use the S&P to make more decisions, but look, takes the stop losses, exceptionally good work by the market makers and the algos and everybody else. And then probably if we get rallies now, we're looking at those potential shorts. So, super critical zone, you can see everything going on here. SPY closes on the low, may look like a little double top to a lot of people. More importantly, it made the higher high, which again could be building that liquidity story. Let's have a look at the SPX. Closes again on the low, directly on the trend line we've had here for a while. And see these two, this unfilled gap and technical gap. Yes, they're not filled, but when we look at the futures market, take a look at how accurate one of our key reactions was. So this is a level that we've had here for a little while. Look what happened. It came up and it triple tapped it and just went boom straight into this triple zone and just shorted straight off that. And for anyone that's done our advanced scalping masterclass, this was a brilliant trade. That if you were patient and you reacted to the market, you actually just waited and you've got an amazing entry. So congrats. I know a few people in the room were posting this to me, and yeah, it's exactly the type of schematic that I look for. So of course you've got a build of a position. You take the stop losses up here in a critical zone. You breach back down by taking out the demand. And then you do a nice pullback, and that's the kind of thing that you're looking for in terms of algorithmics building the fastest position they can. Now, if we're talking about swing traders, what do you need? Well, a swing trader just wants to set alerts here. I mean, you want to set alerts, you want to set alerts, you want to set alerts. If we can breach underneath this and hold the market, so let's say we hold and we come off that trend line that comes off the bottom, we rally back maybe, and then we move through. That's going to be critical. We can get rid of this filled gap because that was filled, of course, in the previous session. Both lines were there. And I like the idea that markets could sell off, but it really has to happen again over the next couple of sessions. We need to breach through 40.68. We don't want, if the markets now make a new high, well, bulls, you can rejoice, because if that occurs, let's say it does this and then it goes to a new high, I still think 4,300, 4,350 is the way. I'm open to both. I mean, we're at a neutralized equilibrium level. We've seen that with inflows. I'm just leaning to the bear side because I know how critical that left-hand side supply is. And there are many other symptoms that are leading into this, such as smart money, dumb money flows, and in general, just everyone thinking it's all green, all good, and everything's fantastic. That's not really the way we want to see it. Again, that sentiment report will help us there. Let's refresh some of the options. It doesn't matter this week very much because it is not a critical week of data of huge amounts of inflow. 420, 39,000 calls, bad luck to them. 412, 35,000, and 405, 400 puts. So we're trading here at 407. Max Payne's at 406, not that it matters too much. So we kind of don't feel like it's easy to get below 400 this week. I mean, yeah, it could go all the way to 390. There's not that much money. But yeah, you can see the call side really being blocked by how bullish people started to become. And in the weekend video, we'll talk about that quite a lot. Let's now look at the old Bitcoin. So Bitcoin, 30,200 was our critical level. And you'll notice here that it comes off this low, which we mentioned in the previous video. So for some people, it will have changed trend down. Not for me. I just can't. I know everyone had stop losses here, and I know that this level is still commitment. So at this stage, we just go straight into there. We see buyers. I want to see that level taken for bears to really start to show commitment. And at this stage, it's just they're selling around 30,400. I'm interested to see if it can do this. Oh man, if it does that, then yeah, okay, let's go down. But yeah, what a great zone for Bitcoin. I need to do some more analysis on it. I do really like the build that's starting to occur, whether it's a bullish build or a bearish build, to be determined. Of course, you would always go with the side of the trend, which is still bullish. But this zone is just, yeah, it's not like that one down here. This is the serious place. So we're going to focus on it as much as we can. If we think about news moving forward, we've got core PPI coming out. Then we've got core retail sales. We have, of course, prelim UOM consumer sentiment. These are all New York Times. So much data coming out. So much fun in these markets right now. If you have enjoyed today's video, please subscribe. Please smash that like button to help out the channel. As I said, always the community here is amazing, and I'd like to focus on maybe getting a couple of comments per day and focusing on some great comments out there. Some of you guys have brought up excellent points over the last couple of years, and I've incorporated even some of the thought processes. So a lot of smart people out there. I know we have all sorts of different professions. Seems to be a huge amount of engineers as well, which are often very good critical thinkers. But it's amazing to have such a great resource, which is all of our community. So yeah, consider subscribing, consider following us on the other socials. And of course, if you're interested in a couple of cheat sheets, you can just click the top link. Thanks so much. See you in the next one. Bye for now.